Hello everybody. We are going to be looking today again at what's going on in global markets. My name's Arno Lawrenz. I'm Global Investment Strategist at Ashburton. The last time I spoke to you, we were in the middle of a crisis. We knew that markets were crashing. This was in March. As you can see, this is the MSCI All Countries Index. And the bottom of the market was reached, I think, a week after I spoke to you. And subsequent to that, it has been as what is termed the most unloved bull market of all times, as we've seen this recovery to the extent that, as you can see, the index has in fact recovered almost back to its peak that it was in mid-February, and only around about 6% below that peak. And the question is, well, is the recovery in sight, and is it time to get back to normal routines and so forth? As investors, the question we could ask perhaps would be, do we keep investing? Do we stick with this recovery? These are the sorts of issues that we're going to be looking at today. So if we look at what's going on in terms of people and opening up of economies, you can see there's a range of countries here. To varying extents, they went into lockdown. You can see at the top there, Taiwan and Korea. We know that, for example, their lockdown was not as severe. They had a completely different approach to managing their way through this crisis. But in terms of actual levels of activity, in terms of the Google mobility scores, you can see very clearly that people are starting to move around again. People are getting back to their normal routines. And so this is what markets are looking at and saying, well, there's a recovery on its way. There's a strategy in which one can deal with the health aspects of this crisis. We know that Google is not permitted in China, so if one thinks about it from a Baidu perspective, this chart shows you some of the different activities in China, but it gives you the same sense of a message in a sense that people are slowly but surely getting back to doing the sorts of activities that they had before. And so perhaps if we had to pause at that moment and ask, well, is this really the case? Is this opening up that we're seeing around the world, in the case of the US as well, being somewhat behind the rest of Europe, in terms of their COVID infections and in terms of their opening up? Is this now just a plain sailing going forward and that there's a vaccine on its way? And so here's the question that I'd ask, which is, if one looks on a global basis, one can see very clearly that COVID cases are continuing to increase globally. And in fact, on the bottom panel, you can see very clearly that where I've highlighted with the red arrow that is where the markets bottomed and have recovered subsequently. Actual numbers of infection have continued to rise. There was a period during May, for example, and April in which they were roughly constant. But this surge that we are starting to see at the end is the spread of the virus into Latin America in particular, Africa, and parts of South Asia. And so certainly from that perspective, the end is not in sight. And so there are the issues around second waves and so forth, which still have to be dealt with at some point in time. And so the question would be, is that the market recovery is essentially pricing in a straight line V-shaped recovery in terms of economic activity. And the reality is that in certain segments, and these are very highly and densely populated components of the world, that the end is not in sight. And so certainly in our mind, there are still some issues that have to be resolved before one can say that there's a complete and utter return to normality. And we even know that, for example, that there will be some sense of different behavioral patterns going forward as well, notwithstanding the fact that we may have some vaccines and so forth. In terms of an index, in terms of a recovery then, this is a chart which shows the recovery in economic activity. And what it shows clearly is that there's around about a 19-20% recovery of economic activity. And this is a mixture of high-frequency data as well as the sort of the more monthly and quarterly data. And so clearly there is the expectation that this reopening of the economies, in particular in developed markets and in China, is a straight-line affair. And at this point in time, we cannot say that with this high degree of certainty that it actually will be the case. And so certainly what it calls for is a level of caution in terms of the markets themselves. And I'm going to come back to this. Obviously, what is key for this, and we know it's a behavioral element here, is consumer confidence. So getting back to normal levels of spending, normal patterns of spending, will require consumers to recover back to their previous levels of confidence. If they don't, and perhaps they follow a higher savings rate, for example, in the future, then it might well be that consumption patterns will be different. And so certainly this is a key indicator that we would like to watch going forward. We know there will be a recovery as the economy opens, but if is there a second or third wave, in particular in Europe or the US, is that this recovery in confidence might not be as straight line as what we would hope for. So the search for the Holy Grail, and the Holy Grail in the COVID-19 crisis is essentially either a treatment plan around medication, so therapeutic, or in particular the Holy Grail is a vaccine, and a vaccine which is safe, effective, and long-lasting. Now, this map illustrates around the world number of countries, and we know there are over 100. In fact, I think the latest number that I saw was about 133 different vaccine programs that are underway in terms of trials. In particular, the ones that have been highlighted is Moderna in the US and the Oxford University in the UK. And we know that even today there's been some news around the Oxford one, which is that they are on the verge of breakthroughs. So there's elements of hope. But certainly, if one has to put together this issue around what markets have essentially discounted versus the reality on the ground of the virus and its impact on activity itself, and looking through that, is that what would be needed to satisfy that scenario is only this, which it has to be a safe and effective vaccine. And again, whilst there's a lot of good news around some of these, here's the truth and the reality around vaccine development, which is that if one looks back across a number of very effective vaccines that have been developed, is typically it takes years and years and years before a safe and effective and long-lasting vaccine is developed. If one thinks about what the scientists are trying to do at the moment, in terms of aiming for essentially an 18-month time scale, it's never been done before. So certainly, if one thinks about what markets are pricing, again, I come back to this, which is that it does warrant a level of caution. It doesn't mean that markets are not going to do well, but certainly it warrants a level of caution in terms of where we see things developing. So let's look at the valuation side of things. And again, in our sort of memory that we have around markets, the last comparative crash that we had, in a sense, was 2008, 2009. And so what we look at here is essentially a comparison of what we have today and the recovery of markets from its low points to the position that we saw in 2008, 2009. So on the bottom, we can see that gray shaded areas is the valuation side of things as at the end of April 2009. And remember, markets bottomed in March of 2009, and so this is just subsequent to that recovery. So what it speaks to here is where in terms of valuations are we? And this is on the vertical axis, is on a PE ratio basis. In 2009, April 2009, we saw that on a valuation basis, things were in the 10th, 20th percentile of valuations over time. Whereas, and on the horizontal axis, we have the earnings growth percentiles. And there again, 10th to the 20th, and in fact even closer, first, second, third, fourth, fifth percentile in terms of valuations. The lower means that it is cheaper. And so certainly from that perspective, in April 2009, and we know the subsequent bull market, is that the positioning of the market post that crisis spoke to a relatively cheap valuation environment. So now let's look at where we are today. End of April 2020, this is the indices that are highlighted in that blue circle. And where we're looking at today in terms of the PE ratio, you can see we're looking at, in the case of the US, you can see an 85th percentile in terms of PE ratio. And yet, at the same time, the earnings growth trend is only sitting in the 5th percentile. Earnings growth, we know, even before this crisis, was slowly but surely reducing. And so certainly we are not in a high growth earnings environment, and yet the valuation points to a completely different perspective. And so if we are required to have a continued bull market from this point onwards, it is unlikely to come from an expansion of the multiple, because we are already at extremely stretched valuation multiples. Having said that, is what it points to again is the market's belief in the recovery, in terms of full economic recovery. And as I've highlighted, is that we can't say that with a high degree of certainty, but there are tailwinds here, and I'm going to get to this here, which is that we are seeing money supply, and we know this. The central bank response has been, around the world, has been to pump money into the system, to ensure that there was firstly, not a liquidity crisis. Secondly, to avert and provide programs to avert a solvency crisis as well. And there are signs that this is in fact taking place. Some sectors we know, the ones which are highly cyclical, some will have casualties. We know this, but it does not appear as if it is becoming so widespread such that we need to, as a market overall, need to worry about a solvency crisis. So we've seen an explosion in money supply on the left-hand panel. And on the right-hand side, the question is, well, what does this do to inflation? And we know if we go back in history, some economists, most notably in history, we've seen Milton Friedman is the most popular one that gets quoted, which is that inflation is always an everywhere monetary phenomenon. So if you are pumping money into the system, somewhere along the line it is going to pop out in the form of some form of inflation. So let's examine this. Most recently, we can see the headline inflation on the right-hand side in the red has collapsed. We know that the initial impacts of this virus slow down, inherently deflationary. We know this. Core inflation, we know over time, has been in fact very, very stable. If we think about 2008, and we look at what the money supply did on the left-hand side, and you look at what inflation did on the right-hand side again, you'll see that subsequent to the crisis is that, yes, inflation rose, but it was very temporary. And so there is a deeper phenomenon at play here in the sense of inflation, is that generally speaking, there has been a very clear disconnect between money supply and the amount of liquidity in the economy and inflation. And you can very clearly see this over a long period of time, how the amount of money within the system relative to the size of the economy has been slowly but surely increasing on a secular trend basis. That is the red line. If one looks at core inflation, subsequent to the 1990s decline, it has been very, very stable, and in fact has been there have been inflation scares, but there has not been a breakout of inflation. Does this COVID virus change things for us? Potentially in certain segments. You could argue that there are certain areas in which almost certainly there'll be some price increases. But this is something which is a fear at this stage and not a reality. And so certainly one has seen a lot of interest in some of the inflation-protecting assets, such as the gold price, for example. And certainly we believe this is the case. In our funds, we've certainly profited from the rise in the gold price, and we continue to have that as a hedge against the fear of inflation. But we don't believe that we are heading into a massive inflationary environment at this point in time. So where does it end then? And this is the question that we sort of grapple with here, is that if this excess liquidity is not going to find its way into inflation in terms of core inflation and consumer price inflation, and we have valuation concerns, then where does it end? And in fact, what it does do is that this liquidity almost certainly finds a home in the equity space. And the reason for this is because of a lack of alternatives in terms of finding assets that can deliver positive returns. And so certainly we have on one side the desire to be defensive because of valuations and because of the amount of conviction that is priced into the market around recovery. And we know that it's unlikely that it could be that high a probability at this stage. We know there's room for disappointment. So it points you towards being slightly defensive. And yet, at the same time, we can see an explosion in liquidity, and a creation of liquidity within the economy is highly correlated to equity assets. And so certainly in our mind, is that what we end up with is equity markets being in essentially a relatively sweet spot, which is that there's a continued demand because of a lack of alternatives. Cash rates are zero. Developed market bond yields are close to zero. And so certainly the only assets which provide any semblance of positive return going forward would be, under a high hope factor, is the equity markets. And so certainly our suspicion is that despite this being the unloved bull market, we're not throwing caution to the wind here and proclaiming that this is a bull market which is going to last for the next 4, 5, 6 years. But certainly it is in a sweet spot, subject to, of course, the disappointments if the projection as far as the vaccine development is concerned disappoints. The other debate that one has then, of course, is, and this has been a long-going debate, which is the value versus growth debate. And so certainly, as soon as one starts becoming concerned around segments of the market being overvalued, one gets pointed towards, well, what about those sectors that have been left behind? The value sector, or the value component of the market. Those stocks which are poorly valued, if one wants to put it like that, or cheaply valued. And we know that for the past 10 odd years, there's been consistent long-term underperformance of the value component of the market versus what one terms the growth component. And one only needs to again point to the tech sector and the mega caps around that space, which have been the predominant growth icons, if one wants to put it like that. And so certainly one can see in this chart, which is the relative valuation between value and growth, is that growth has, yes, outperformed to the extent that we're getting back to some form of an extreme. And so the question is, well, is value going to have its day? We know the saying, every dog has its day. And so certainly in our mind, there might well be a period in which value is being essentially left behind, and there may well be some form of pushback towards some form of a trend. But in our view, it's unlikely to be a long-lived period. Why? Because the conditions that one looks at the moment in terms of close to zero interest rates, favoring, of course, in terms of a discounted factor basis, the earnings progression, and in that case we speak about the growth stocks, means that it points you back towards that again. So from that perspective, one thinks about, well, why are the value companies poorly rated? And the answer is, in fact, is their earnings patterns have not been resilient. And the question we ask then is, well, what's going to change going forward? If they've been poorly, or if they are poor in terms of their expectations, poor in terms of delivery, and poor in terms of resilience, then surely we are not about to enter a period in which these sorts of companies are going to become suddenly resilient. And so this is the reason why we caution this issue around a rotation, or the question around a rotation between value and growth in terms of style side of things. And so certainly it becomes a more and more difficult situation in terms of finding where does one position in terms of your investments, such that you can become defensive without losing track of some of the upside. And so we've looked at some of the defensive assets. In particular, if one thinks about fixed income, in a multi-asset fund like the ones that we have, the Ashburton Global Growth Fund, we also try to say, well, we have a fixed income component of the fund. How do we be defensive without sacrificing some of the upside return? So if we look at this chart, for example, on the bottom side of things is the yield of certain bonds around the world in terms of the blue dots, the bonds of the different countries, as it was on the 1st of January. So if one highlights, for example, there in the middle, the US. So you can see that if one reads down to the x-axis, we're sitting at around about 2% yield. That's a 10-year bond. And if one then draws a line across to the vertical axis, one can see, well, what is the return that one got from the beginning of this year by investing in US 10-year bonds? So if it started at around about just below 2%, you would have delivered a return of somewhere around about 14-15% year to date, which is a great return. So certainly it was defensive, but if one wants to be defensive today, where are we? So again, if one thinks about where are US 10-year bond yields, this is slightly out of date. So if we think about where that line, the vertical line is drawn on the left-hand side, US 10-year current, sitting around about 0.6. And this was about a week or so ago. And if one then said, where would one be able to get a defensive orientation around this, you'd probably be looking at somewhere in the region of around about a 4 or 5% type of return, which again, if one then looks at a lot of the different assets in terms of Germany, France, Japan, all sitting at the bottom left where they are at the moment, is it's unlikely to provide any sort of upside in a defensively oriented fund. So all you're looking at really is a protection of capital. And in fact, then one doesn't need to take that risk. One can sit in cash for a period and one will earn zero. So there's no need then to take the risk being that bond yields spike upwards and you make capital losses. So certainly bonds don't deliver the sorts of defensiveness that one would typically see in previous environments. For example, as we saw in 2008. So again, one starts to run short of these protective assets or defensive assets. One that we do quite like at the moment, inflation linkers. So if one looks at where those red dots are, for example, you can certainly see that they've been fairly defensive and continue to provide a hedge against, as I mentioned earlier, the fear about a resurgence of inflation. It's a protective mechanism, but certainly we don't believe that one needs to be afraid of inflation at this stage. One other position that we've looked at and we have implemented, for example, is also in implementing or opening up positions within the China sovereign bond market. So certainly you get a decent yield pickup. We know that China is opening up its markets to global markets and becoming more integrated with the rest of the financial world. And so certainly there is liquidity there such that we've been able to implement a position within those sorts of bonds. So it provides us with a much more decent return and a defensive nature, but certainly it's not a key component of the funds at this stage. Gold, as we sort of look at this particular point in time, we did favor gold producers. They've rebounded very strongly. We've now shifted our focus from gold producers into physical gold in terms of gold ETFs. So certainly that is something which we've retained at this point in time. So in terms of our overall strategy, which we've maintained over the last month or so, has been what we call a differentiated and graduated risk increase rather than an all-in approach, which again, with hindsight, one could say, well, did we not see this coming? And so certainly, no, we didn't see this coming in terms of the recovery to the extent that it has. We were fortunate not to become overly bearish, in particular during that point in March, and we sucked into that. And so certainly we've maintained an overall neutral perspective as far as our equity position is concerned, and also neutral as far as the sectoral positions are concerned, avoiding the obvious casualty areas like, for example, transport and so forth, and which we've discussed before. What we do like, of course, is to aim to increase our risk in those areas or segments of the market where we have access to higher quality liquid assets, where there is a backstop. So, for example, in investment grade corporate bonds, we've really enjoyed the benefit of that over the last couple of weeks. Why is there a backstop? Because you have the Federal Reserve, who has been essentially purchasing corporate bond ETFs, and so being able to essentially ensure that segment of the market does not get pushed out or subject to big negative moves. And so certainly that has been something which we've been a beneficiary of, and we think that is likely to continue for some time to come. The other side of our positioning has been largely in the context of being cautious, is to avoid those regional areas that we think have been behind the curve. And certainly we've been vindicated in this, in particular around, if one looks at, as I mentioned earlier, Africa, Latin America, and some parts of South Asia, most notably in India, for example. So in particular, these are emerging markets outside of Asia. And in particular, what we want to focus on where there has been, where we do have the ability to have a look through in terms of earnings transparency. And so certainly in terms of overall equity risk, is the focus must be on resilience. And we know that, for example, within Ashburton's Global Leaders Fund, we know that the strategy there is to focus on, for example, high quality companies and robust balance sheets. And certainly that is a trend which we like to pull through across our fund range as well. In terms of this outlook then, if I can just pull it all together, is this liquidity that we have at the moment will be an underpin for markets for at least the next 6 to 12 months. Certainly we suspect that there might well be a valuation overshoot, and if this were to happen, we certainly would caution around that at some point in time valuations are going to count, and there will be a rotation away from the highly valued sectors to more defensive ones. But again, as I pointed out, is that this shift towards value is not going to be a long-lived one, because we believe that what you're getting what you pay for in the form of resilience and quite high-quality companies. We believe investment-grade credit is a beneficiary of a lot of these central bank actions, and so certainly one still needs to be selective around the individual names and sectors and avoiding the potential crossover names, and we believe that is a strategy which will continue to work going forward as well. In terms of the overall positioning in equity, and this is a crucial one, which we don't believe that at this stage, given where we are, is that a completely overweight position in equity is warranted. We still believe, given the nature of the virus spread around emerging markets in particular, and the possibility of a second wave, is that the earnings recovery trajectory is unlikely to be a straight line one upwards again. So certainly, as I highlighted right at the beginning, a vaccine development becomes absolutely crucial for the recovery. If this is delivered in short period of time, and as we know in the US, they've got an Operation Warp Speed, if this is possible, well then certainly the markets will be right and correct, and certainly we'll see a boost to markets as well going forward. One of the risk areas that I highlighted, of course, was emerging market risks. We think those are rising. We know that this is also an election year in the US, and we know that President Donald Trump is behind in terms of the polls at the moment. And so certainly he will have to formulate a strategy around regaining the trust of the American people. And certainly I think a part of this will point towards, and there have been elements of this already, is blaming China. And attacking China for their approach around the virus. And so certainly we may see a resurgence of the turbulence and volatility around this relationship between China and the US, and may damage some sentiment depending on how strongly this is voiced. And so certainly if one combines that with the COVID-19 risks within emerging markets, we know that those are potential danger areas which can derail where we're going to. So I'll park it there, and I'll be very happy to take questions that we will answer, and we can see how things develop from the question side of things. Thank you. The first question that we have is, do you think that the environment that we are going into will encourage an increase in passive management? And that's quite an interesting question given the uncertainties that we have. And so certainly one could suspect, in a sense, that passive management is sort of a cop-out in the sense of that you're not taking any active stock picking. And so that would speak to an environment in which you have heightened uncertainty and greater difficulty in terms of trying to capture alpha. And so certainly in my mind, this sort of environment that we're heading into, where we have obviously enormous increases in terms of the ability to sift through data using quantitative models and computing power. And secondly, where the uncertainties that face us are significant. Certainly, we are having increased certainty around the actual pandemic and the virus, but the outcomes in terms of longer term are in fact increasing, and we know that these are nonlinear systems. So I suspect that if one looks at the history of the last 10 years, hedge funds have really struggled to be able to extract alpha on a consistent basis. And so certainly I think the environment that we're heading into is one in which, to a certain degree, it becomes safer to hide in the herd. And by that I would mean active, passive management. So certainly there is an argument to be made that this sort of environment does push one towards a more passive approach rather than an active one in that respect. Right, and moving on to the next question is, how do you think the outcome of the US elections will impact markets? Well, certainly if we think about where the markets are at the moment, the starting point, as I've mentioned earlier, is important. Valuations are important. So in that respect, one has to sort of say, well, okay, if Trump wins the election, then what does it mean? A continuation of what we've seen before, certainly. So it's a business-friendly environment. And I suspect that we would see a similar sense of focus on helping out the large multinationals. And so certainly from that perspective, I would suspect that overall, over the course of a medium-term environment, is a Trump win would most likely be good for these sorts of companies. Unfortunately, in my mind also, though, is that there are the ramifications of perhaps his electoral strategy, which might play out and come back to bite him, which is increased adversity towards China. And so certainly there would be some issues around that and whether that would continue. So let's move on then to a Biden a win. What would that mean? In that respect, I suspect, initially anyway, is it would perhaps temper enthusiasm for sustained gains, and certainly where we are at the moment with heightened valuations, the market would almost be set up for a period of weakness perhaps. Having said that, of course, is in the longer run, is that perhaps there would be a reclamation of some of the US's standing in global markets. So from that perspective, perhaps in the long run, it might well be better for markets from that perspective. Okay, so then the next question is, when do you expect the Fed to stop expanding their balance sheets? That's a difficult question to be able to answer in the short term. It's going to be when the Fed decides that they do not need to be at the forefront of supporting the economy by pumping liquidity. It's an important one as well because, as I touched on in my presentation, is that this amount of liquidity will be an underpin for markets for a period of time, in my mind anyway. So certainly from that perspective, I would suspect very similar to as the person has asked is in terms of ECB, that it's going through to 2021. So certainly it's going to be as long as it takes, and it's not going to be in the foreseeable future. And so certainly I still think that this is going to be an underpin. Where do we think equities get to in that respect? I touched on this. Equities are in a sweet spot, except from a valuation perspective. And this is the one concern that we do have, is that despite the liquidity, there's always going to be the risk. So certainly, if I tie it back to the question around passive investing, it does push one towards saying, well, I'll abdicate the decision of trying to discern where I should be investing. That's a very easily a decision that individual investors could try to make. And so certainly from that perspective, I would think that, from a perspective of markets themselves, being in a sweet spot, having the liquidity support for at least the next year and a half, I don't think we need to worry about that reduction in the Fed's balance sheet or the ECB's balance sheet for that matter for the next little while. So the next question is, have we seen any signs of resumption of the carry trade by foreign investors? I'm pretty sure that we will be seeing that. I think it's still early days. So what we've seen over the last little while in terms of the impact of a carry trade into, for example, into the emerging market currencies. Most recently, we have had a period of strength, but I think that's more related to dollar weakness on the back of essentially a change in the outlook because of the unemployment numbers that we saw a week or so back. So certainly I think there will be a resumption of the carry trade. And again, it comes back to this issue of whether there are any alternatives for risk taking. And so certainly the carry trade would definitely be one of those trades that investors on a global basis will be looking to add to their arsenal once they believe that emerging markets are able to look through this COVID infection curve. I think that is it for the questions at this point in time. I'll do a quick refresh to see if there are any further. Nothing further coming up. So I will happily park it there then in terms of the questions. Thank you very much for attending and for listening. I hope it has been helpful to you, and hopefully you will be with us again at the next one as well. Thank you very much.